Aishwarya Didish of Fident Asset Management. Aishwarya, a very good morning and a very happy new year to you.
Good morning, Lavisha. Happy New Year to you and all the viewers, and wish them a lot of luck for their wealth creation journey.
Thank you so much, Aishwarya. Aishwarya, last time we spoke, you did mention how it will be difficult for the markets to tread higher in the first 3 to 4 months of 2025. Now that we have seen a significant sell-off, do you still stand with this view, or do you expect any, change of course to take place?
If we like, obviously, we are starting this calendar year, but we should not forget that this was the ninth consecutive positive return from calendar perspective of our Indian market. And if I look closely on FY calendar year 2024, the first half was very robust, right? We made a very decent return, which was large part of it was washed out in later half to 2024, and we all know the reasons around that. But obviously, calendar 2024 was a very difficult year with a lot of geopolitical things happening around election in major countries, including India and US, and we saw all sort of slowdown in consumption and things like that, which was played out. But as we enter calendar 2025, I believe that there will be two important determinants for the market to do or find out cues from here onwards. So the most important thing I think the market will be taking care of is how this quarterly season pans out. We have seen a very muted set of number in quarter two, and the expectations of quarter three are all not that great for us to really pick up the market very sharply in the initial part of the calendar year 2025. So I think the most important determinant is how this quarterly third quarter pans out and what kind of cues it will give to the market. And on top of it, when Trump takes over the office, I think in around 19 or 20th January, the announcement that will dictate the terms of the market, both global as well as India. So in short, calendar 25 will to me look a bit difficult market. What we have seen in the last 3 4 years, you spray and basically pray and you create wealth. Possibly aren't happening in this calendar year like what we saw in calendar 24 later part. A lot of this mid cap and small cap or even large cap where we have seen value being beaten down in the last 6 months, we haven't seen that swift recovery yet, right? And that will only happen if we see some sort of a positive surprise on the earning momentum, and if we find more rhetorics in Trump new administration than substance, which can really, dismantle the whole global equity market and things like that. So I'm a bit cautious, Lovisha, for the initial couple of months. And I believe if things do well, possibly we will see some sort of strong market hold in the second part of this calendar 25. So investors have to be cautious, at least for the next couple of months for sure.
Okay. Aishwarya, you did mention about the Q3 earnings season that markets are still on a wait and watch mode as well. So, what are you expecting from India in this time? Are you expecting, because Q2 was quite a dampener. It was quite a disappointing quarter for the investors. But now we can see the private sector growth has picked up. Inflation has also moderated a little bit. So, where do you see Q3 earnings? How do you see the growth projections for quarter three?
So the expectation of Q3 are already muted. Like market are not expecting any firecrackers happening anywhere around, right? If I closely look at that, the slowdown we witnessed in consumption is not very clear, right? There are still some pockets, some areas, especially say in rural side. If you look at say discretionary side, two-wheeler side, uh, possibly things are looking good. What I understand is, there are a couple of sectors which can possibly show us slightly bad numbers. Say chemical can be one of them, where we are not seeing much recovery happening on prices and volumes over the last 3 months or so. But if I look at the large sectors which will actually dictate terms, if say BFSI, they're expected to report decent numbers. Right, we obviously saw the credit growth come out slightly lower, but with interest rate cut happening around the corner, the expectations of some pressure on NIM and some pressure on return ratios eventually, but no negative surprise at least from the large private banks and the PSU banks are expected. IT, I think, will be more or less decent. We've seen Accenture, we haven't seen any so far warnings on IT from any of these companies, so I think they should do well. If I say the last quarter, the biggest drawback or the drawdown was happened was with the oil and gas. I believe with stability on the crude prices and with the improvement in the petrol and the diesel crack, even if you see the Singapore gross refining margins have also improved up. So they can surprise slightly on positive side because the expectations are low. But I'm not really expecting too much happening around. So it should be a muted number. Even if the reported numbers as expected, I think market will take it positively. There are certain sectors like consumer discretionary, obviously, and things like that, which can give us this positive surprise. FMCG particularly can provide with a strong rural segment, can be the joker in the pack, can give us good outcome of that. Hotels could be one of them, pharma and healthcare, but not too much expectations have been built up. That is what my point is. So we'll see how this quarterly season pans out.
Are there any sectors that you believe is going to be more, on the downturn and could disappoint the markets from the Q3 results?
So the one which, as I mentioned, which comes to the top of my mind is obviously chemical. Chemical is one sector where we were expecting recovery happening around, but if I closely look at month-on-month prices of majority of these chemical products, we are not seeing much of improvement. Actually, we have seen some of the chemical commodities have actually gone down in prices, which will possibly have some negative or adverse impact on many of these chemical commodities related businesses. So chemical is one of them which possibly can surprise negatively more than what the expectations are. If I just look at some of the data, you see industrial real estate have done phenomenally well in this calendar 24. But the pickup in the expenditure when you saw the June 2024 hasn't really done well, and there were expectation that government will push things going forward. But when we saw the data coming on December 2024, we haven't seen much happen both on the private as well as the public capex. And we are just almost like a couple of months before we close this financial year. So a lot of this, I would say, industrial and possibly all of that, which are a play on consumption, also which are play on investments, might surprise us adversely in this quarter. So that is one of them. Auto, if you see, should be like there have been investors darling, one of the best performing sector, especially in the H1 of 2024 in calendar year. Possibly will not really put up great numbers. So I believe auto also would be kind of a mixed bag where the expectations are pretty decent. So chemical, industrial, and automotive are the area which can cause negatively surprises than what the street is expecting.
Okay. What about the new age themes, Aishwarya? Because we did talk about traditional businesses, but what about how are you viewing like the Zomato, Swiggy, or PB FinTech for that matter?
So we are, I have to put it a big comment here
Mm.
that we are very, very positive on this whole space. I believe when the way we are moving up close to $5 trillion market cap, which India is playing close to $4 trillion GDP, we can't be much bigger unless we really create a lot of wealth in these businesses which are powered by digital, right? So even in our fund at Credent, we have a decent exposures to the Zomatos of the world and other digital companies. And I believe the growth is very, very strong in sectors like in segments like this. And as I said initially in my initial when we started this, that money making will not be very easy in this calendar year 25. You have to stick with businesses who are reporting strong earning growth, where we are seeing that the re-rating potentials is very strong. And one of the sectors which comes to the top of my mind is all of these new age businesses. So that is we are very very positive on that. But obviously, the valuations here are pretty stretched. A lot of easy money making has already happened. So one have to be very careful that the quarterly results for the next 2 to 3 quarters live up to the expectations of the market in businesses like this. Otherwise, the derating can also happen very swiftly. So one have to be careful. But when we are doing our analysis and we are making in our own numbers, we believe that these businesses of new age businesses, even the platform businesses, where there's a play on financialization of saving, are expected to report very, very decent numbers. And we are excitedly looking forward to the numbers that they print for them to sustain this kind of wealth creation that they provided to investors.
Okay. Aishwarya, after Q2, plenty of earnings downgrades happened. Markets did see quite a bit of a sell-off. And, a lot of sectors also did see a lot of correction as well. So any sectors that you believe would warrant more correction from here on? if the Q3 earnings, if you believe that the Q3 earnings is not going to pick up pace in line with the market expectations?
So, see, one thing I want to really point out to all the investors or viewers here that if I see the last, say, 4 or 5 year of earning trajectory of India, and we look at how the stock performance has been, right? They are more or less in tandem. So, earning growth from FY20 to FY25 expected is close to around 16-17%, right? And where when we look at the price performance, it's been close to around 14% CAGR over the last 5 years. So we have not seen huge amount of valuation froth being there in many of this, especially after the last 6 months when we have seen that de-rating happens very very aggressively. In a lot of the sectors where earnings didn't hold up well, especially in mid cap and small cap, and many of the stock which has gone down 20, 30, 40, 50%, they haven't recovered their the decline so far, which over the last 3 years we have seen it has happened swiftly. So why I'm putting this data is that a lot of this slowdown in the earnings in majority of these companies has been properly factored in. Even if you look at Nifty 50 valuations, we are trading close to 20 times forward, which is almost in line with the long-term 5, 10-year average. Right? And there are obviously some froth in mid-cap, which are basically trading at 50 times, 50% premium to large caps. But the lot of froth has been taken care of. So even many companies, if they report really bad numbers, then there is a case. But a decent number or a muted number will not see significant de-rating as you asked. But specifically coming to sectors, one sector which comes to the top of my mind is BFSI, because market is very very positive on BFSI as a vertical. There are two specific reasons. If you have seen the RBI stability, financial stability framework in the report which came out, BFSI is standing very very strong from majority of these operational parameters. Whether you look at from asset quality, capital adequacy, if you look at from other important parameters on BFSI. And even if you look at the credit growth and deposit growth, which was basically missing, has also inched up. So the expectations from BFSI is decent. But if we see some sort of surprise, like what we saw with IndusInd Bank with MFI exposure last quarter, if we see some negative surprises coming on BFSI, then we can see some bloodbath happening, because last quarter the investors are very very bullish because of the valuation and the growth part. So that is one sector which I will be very very careful of, especially in quarter 3.
Aishwarya, what about the microfinance sector? Because in the RBI report also, like you were talking about, we saw that the stress did double from the April to September period. So how should traders position themselves for the MFI sector?
So, like, even in various of my previous interviews, I have categorically asked investors to stay away from MFI. I think it's a very beautiful business, but you have to time it with perfection. You don't make this kind of ROAs and NIMs across any of this other BFSI vertical. But I somehow believe, if you look at many of these companies, the small finance banks who have a decent exposure to MFI, they're all down 40-50%. The problem is, as you mentioned, that we are not seeing any recovery happening on asset quality with our interaction with many of these companies. So the pain is here for at least some more quarter, right? So even if investors who want to be opportune and get into these companies, I believe that there could be a 6 month, 9 month kind of a stress in the whole system before we see any sunshine. So that the risk reward is not really favorable. In spite of the valuation comfort. And coming back to your questions about the negative surprises, is I believe a lot of these companies who have exposure to MFI possibly will come out with more deteriorated data in quarter 3. This is what we're expecting at Fident. So we obviously are not having any exposure to MFI, but if anyone want to keep or bring that exposure, I believe it's not in yet in time. You still have a couple of quarters to wait out to see really how the things pans out. Similarly, like Lavisha, what happened in chemical, the markets was very expecting gradual recovery in chemical prices and things like that, but that still hasn't turned out favorable. Same thing possibly will happen in MFI. And if you look at this stability report, the area which I think the RBI is a bit worried about is unsecured lending and businesses like that. So we have to be a bit more